All right. Very good evening to all of you. Today is April the 16th, 2022. And the time now is 8 p.m. in the evening. And I'm very happy to be welcoming all of you to our weekly uh, derivative trading tutorial. Um, Please allow me, first of all, to do a quick sound check. Can someone just say good evening or hello so I know we can hear each other, please?
Hi Sam, hello.
Hi, hello, good evening. Thank you. Now, a few things to let you know. So thank you, first of all, for joining me on this Saturday evening. Um, I know there are a lot of, I don't want to say better things, but a lot of good things to do on a Saturday night. So do, I do appreciate you taking the time out and signing on. Let me just get the file. Now, this file that you are now going to see, it is in Blackboard already. And, you know, one reason I thought it would be good to run a, oops, sorry, my thermal just leaking. It would be good to run a tutorial today. Is we are close to our midterm. Which is happening in a few days' time. So I just want to give you a briefing on how we're going to go about doing that. And today is the best time to do it. Now, this file that you are now seeing, it is in Blackboard. And I want to just start by going through some housekeeping matters. So this is the layout for Xinming, as you know. So we've completed most of these things. Well, that assignment, that was it. So one assignment would get you, even if you divide all these numbers by 2, you still get 20% for that assignment. And the trading exercise, I hope you all had fun doing that. And I hope you learned something too. So we have an exam next week on Tuesday, and that's about it. And this is when we welcome Professor Robert Park. So we'll keep you up to date on that. And then now, there's one thing to remind you. So if you go over to the Google Sheet, there is one, not this one, for derivative trading, which is your class. So you are supposed to form teams. And I can see that some people have. These are all to do with some American junk fast food. There's Big Mac, chicken burger, and fish fillet. Okay, I get that. But those of you who have not formed a team, you need to do that ASAP. And I'm going to give you until, and this is the only way it works, okay? I give you a deadline. I'm going to give you until the middle of next week. So, you know, we have an exam on Tuesday, right? That would be August 19. I'm going to write it down here. So not August, April 19. So end of April 20, that is a Wednesday. So I'll give you one more day in case you're busy between now and Tuesday preparing for your exams. So end of Wednesday, please form the other teams. Otherwise, I'm going to do it for you. Okay. I think we have 35 people in this class, as I recall. Let me just quickly check again. Hold on. Yes, we do. So we have 35 people, and we need to have one team of 5, and all the other teams will be 6-member teams. Okay, so please do that by end of next Wednesday. End of next Wednesday. If you don't, then I will help you out, and you can't complain because I've given you plenty of time, and I'm now giving you the second, maybe the third reminder. So please do that. Okay. And then, well, Robert will take over from April 26th. I've never worked with him before. Okay, so it will be interesting. For Robert, as far as I know, there is no exam. So once you've done your midterm for Xinming, that's it. So for him, there are online quizzes every week. Okay, so these will be done, I think, during the lecture, and then there's participation, and you can earn some good marks on that too. Just speak up, ask some questions, make some comments. Okay. Yeah. So remember your team membership. Okay. And then so that's the calendar. One more thing to remind you, I can tell you that right now. Okay. Now we are meeting today, April 16. We don't meet next Saturday, so give you a break. The next time we meet is supposed to be 2 weeks from now, Saturday, April 30th. It is very likely that I cannot make it that night. I have a medical procedure. It's an appointment. It's already scheduled, and that will happen on that day, on Saturday, during the morning or afternoon. Okay, so I think I'm likely to be slightly incapacitated. So what we can do, I mean, I don't want to disturb your Sunday. So it'll be Sunday, April 31st. No, what am I talking about? May 1st is Sunday. So Monday, May 2nd. So I am likely to push that to 48 hours after. Now, I am aware that this day also is a public holiday, but I apologize. I really don't have a choice because you can see all these dates are all packed up. So if I don't do it there, I don't know when I'll do it. Okay, so I am planning to move this tutorial, and please forgive me for doing so. I may be a little bit unwell 2 weeks from now, but I think I should recover very quickly, and then we can do that on the Monday. Is that okay with everyone? Now, if you can't come, it's fine. Fair enough, because we normally meet on Saturday. So if you can't come, then you know, just let me know, and I'll try and make let you have access to a video. Is everyone okay with that? Yeah. Now, okay, I'll talk about the exam a little bit more. So someone had Li Zhen had a question. Okay, so these slides, as I said, they are in Blackboard. The midterm will be from 6:30. So Li Zhen, I answered your question already. Okay. you just log on to Zoom, or you need to log on to two platforms. Zoom is one of them. The other is our friend Blackboard. Okay, listen to this part carefully because you really do need to follow. It's going to be 2.25 hours. So we should finish somewhere around 9 p.m. hopefully. Now there are short questions. Actually, there's more than 6 because some of them have sub questions. So one question and they're broken into. So ignore that. There are short questions. Okay. I don't remember it's 6 or 8 or 10. It doesn't matter. Okay. And the questions are not equal weight. They are not equal weight. Okay, so you watch out for how many marks you get per question. Now, you're going to answer your questions in Blackboard, Online Capture, and Blackboard folder. Now, what do I mean by that? It means for some questions, you just type your answers directly into Blackboard. In other words, okay, you're going to receive your exam in Blackboard. So on the night, when you click on an exam paper, once it becomes available to you, approximately 6:30 or 6:45, whatever. Once it becomes available to you, when you click on it, you click on a question, then there will be space underneath for you to answer that question, except for one question where you have to download some data. And so we need to let you have access to the internet. You need to download some data, you need to plot some graphs, or I don't know what it was, or draw a pair of diagrams or something like that. Okay, but don't worry about what it is. Don't be concerned about what you need to do. Be concerned that there is such a question. Okay, so for that question, you will need to hand in either Excel or Word. Look, on the day, just look at the question carefully. All right, Excel or Word or both. And we're going to set up another folder for you to do so. All right. And so you just answer most of the questions actually in Blackboard Online Capture. And there is one question where you have to download stuff and then analyze it a little bit and possibly hand in your Excel and your Word or PDF if you want. Okay, PDF document. And we will set up another Blackboard folder. In other words, everything is captured in Blackboard. Whether you are answering questions direct or whether you are submitting to another, exam folder. Is everyone okay with that? Do you know what I'm saying? There are some people who haven't turned up tonight. We have 35 people but there are only 23. 2 of them is me. So there's 21 of you. For the other people who didn't bother to join, fine, it's your freedom. But if for any reason you don't listen, you're not listening now to my instructions, and then on the exam night, and then you mess things up, then I think we're likely to be just a little less sympathetic.
Okay. Hello, Sam. I have a question here.
Hey. Hi, is that
yes. Should we submit the answers on Blackboard rather than submitting a Word file?
Well, that's exactly what I'm saying.
Okay.
No. That is exactly okay. I don't know. Forgive me if I spoke too fast. Let me be very, very clear on this. All right. So there will be, I forgot how many. Let's just say there are 10 questions. Let's just say it doesn't matter. Okay. Let's just say there are 10 questions. They're all randomized for everyone. So everyone will be tackling the exam in a different sequence. So all of these goes up. All of these except one, all of these you answered inside Blackboard. In other words, when there is a question, I mean, you've taken exams in Blackboard, right? So there's a question, blah, 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 blah. And then underneath, there is some space for your answer. That is what I meant by Blackboard. Hello.
Oh, but I'm wondering if my computer goes wrong suddenly, will my answers be stored?
Yes, it will. Well, thank you for asking me that. If for any reason you have a power outage or your computer got disconnected or your internet got disconnected, you just come right back and you can jump in. It'll take you to where you left off. Okay.
Okay. Thank you very much.
You're welcome. And that is consistent with all the other exams I have ever covered. We make that a policy. But
Sam, one question.
Yeah, go ahead.
For the one outlet question that we need to do it outside Blackboard, do we need to file it through VeriGuide?
No, it's okay. No, but please don't plagiarize because we can tell. Don't ask
So
me how.
basically, the whole answers for this complete exam does need to go through the VeriGuide.
No. If it goes through Blackboard, and we are, I trust, just giving you just about sufficient time to complete your exam. So you don't, and then because all the questions are randomized, when you are doing question 1, somebody else is doing question 6, somebody else is doing question 9. So there's no point trying to attempt a collaboration. Please don't. I know you won't. You're all good guys. Okay. So yeah. So I don't think we need VeriGuide because the output that needs to go in here would be okay. I think all right. Some graphs or some data tape. I can't tell you everything. All right. And then, I don't know everything anyway. And then you need to do some explanation or you need to write some comments. So that one question. So Li Zhen, are you okay? You're okay now? So then that one question we'll need, and we will tell you which one it is. All right, we'll tell you, okay, for this question, you need to prepare, you need to download, you need to prepare, you need to go somewhere else and submit via another folder. Okay. Li Zhen, are you okay? Because I'm a little concerned that you misunderstood me. Are you okay now?
Oh, okay. I'm okay now.
Okay. If you're not, just give me a yell. Okay. Okay. Now it's open book. Yes. Hi.
I'm sorry to interrupt.
Oh,
I have a question. I'm just worried that because my network isn't stable, I'm worried that my answers will not be saved in that case. So can I answer in a Word file first and then copy the answers to the Blackboard?
You know, I think that is actually not a, I think that is a good strategy if you wish to do so.
Okay, thank you.
Yeah, I mean, I can't stop you from that. Yeah, yeah. But please don't share the answers around. Okay, we can actually see what you're doing. I know you guys won't. I know you won't. Okay, I'm just thinking aloud. Don't do this either. The chance of you being able to find answers from Google is quite remote. But even if you can, let's just say you can, and then you, oh yes, I got this. You go to a website, you do a copy and paste. The teachers can tell within 0.007 seconds. We know you didn't write that, and you just copied it from somewhere else. How do I know you even understand? If you just copy from, you know, Dr. Google knows everything. I know, but we want to see you expressing your answer in your own words. I much prefer that than reading something from Dr. Google. Okay. So try not to do that because we can tell, and it will not get a high mark. Okay. Now, so there are general online protocols. What are these things? I mean, you know very well. It's not the final exam. It's the midterm. So you need a computer. You need a phone. You guys are experts on this now. You are better than me because I don't need to take exams. I just need to manage an exam. So it's going to be recorded, and you just set yourself up in this manner. And we need to see you. We need to see your computer. We need to see what you're doing. We don't want to see people having a little box at the corner with the WeChat. We absolutely do not want to see that. And then I need to see your computer. If you have scrap paper, fine. Don't do this. Cannot see what's going on. And don't do that. Cannot even see your computer. Don't do this. I can't see your screen. Okay, I can just see you. I know some of you, you sometimes have two cameras running, and it confuses me. And when you have something like this, it makes me think, oh, did this student turn on another camera or something, or is that the only one they have? But if you do that, fine. We will be checking, okay? Because this is a small class, we are able to keep a very close eye on everything, and we will, okay? It's easier to manage. So the entire exam will be under surveillance. Do turn on your speakers. Switch off your microphones. So if you turn on your speaker like you are doing now, okay, you turn on your speaker so when we talk, if there are emergencies or some typing errors, gets the message, but you don't. All right. Use a keyboard and answer question for the exam in Blackboard. Okay, here you go. There is one question that you might need to use Excel and Word and PDF, all of those things. For that question, you just submit to a separate exam folder. So, sorry, this is a little bit complicated. Okay. What else?
Yes,
Yeah.
ma'am, I have a question.
Yeah, go ahead.
For example, when we are calculating the value of swap, and we may use the Excel to create a table and to calculate it. Is that possible? We paste the table into the Blackboard. Does the Blackboard support it?
What do you want to? I'm sorry. What do you want to put in Blackboard again?
For example, when we're calculating the value of swap, we use a table to calculate the percent value, right? And in the Excel, is that possible for us to copy and paste the table on the Excel to the Blackboard?
The short answer is yes. I would love, if you want to be adventurous like this, I would love to see it. However, just give me a second. Give me a second. I understand your question. Okay. Now, hold on a minute. Okay, I want to give you a complete answer to that question. So just bear with me 1 second. Okay. Okay, now I'm going to switch over. Was that Wan Jie? Just now, who asked that question?
Yes.
Okay, now I'm going to switch over to another. You asked a good question, so I will respond to it. Okay, now, if you really want to do that, I would love to see you try to be adventurous, but the way, okay, I wasn't expecting someone to ask me this, but since you did, now let's say this is so what you now see is just some space. Can you see what I'm typing?
Yes.
What am I typing? What did I just say?
Happy Easter.
Happy Easter. Yeah. Now let's just say, so when you are doing the exam, all right, it will be like this, and you will have space to answer questions. And I don't think there are any you don't need to write elaborate formulas except plus or minus, multiply and divide, and maybe to the power of, okay, you know, the exponential, you know, 2 to the power of 3 is equal to 8, etc. Okay, but anyway, that's not the answer to your question. The answer to your question, Wan Jie, is you need to come here. See, there's a little icon that says add content. Can you see that?
Yes.
Now, if I click on this, it will say, and then I'm going to say insert local files. Again, I emphasize you don't have to do this, but if you want to try, go right ahead. I'm not going to stop you. And I'm going to go pictures. And I'm just going to randomly, now these are all JPEG files. These are all JPEG files. So these are all picture files. So if I pick that one and I click open, can you see what's happened? I inserted that picture into my answer. Wan Jie, this is how you would do it if you really want to. It can be done. But it's not a requirement that we ask you to include pictures. in your
I
answer.
see there are many pictures for the
Mm,
usually we are using the Excel to using the Excel table to calculate the present value of the
Yeah.
swap. So I'm
Yeah.
wondering to okay,
Ah,
I understand now.
well, yeah. But then you would have to think of some way to save your Excel table as a figure. I think when you add the content, you just insert local files. Look, you know what? If on the day, if it gets too complicated, don't push it. Okay, I just inserted another diagram. Yeah, that's how I know
Oh,
you can
I see.
insert picture objects into Blackboard. Okay,
Okay,
is that all right?
thank you.
Yeah, no, thank
Yes.
you for asking that question. Thank you for asking that question, which allows me then to share some further instruction. Otherwise, I would not be saying this. Okay, now I'm going to just cancel this and then go back.
Hello, Sam. I have a question here.
Yeah,
if
sure.
if I use the Excel to calculate swap, should
Yeah.
I transfer this table into the photo and I submit the photo later, or can we just insert the Excel into it?
Can you
Because I
insert?
want.
Okay, I hear you. I hear you. All right. Can you insert that Excel into your question, into your answer?
Yes, because I only see photos just now.
Yeah. No, give me a second.
I guess in this way we can use like screenshots.
You can use who was that? Who was that?
I'm sorry, I'm sleeping.
Steven, yeah, you're right. You can indeed use screenshot. That might be a better way, Yichen. Just do a screenshot. Do a screenshot and don't blow up your computer with very complicated operations. Yeah, I think Zibing is right. First of all, you don't have to do it, number one, okay? But if you do it, I guess for me, I welcome that. But just keep it simple. You know? Are you with me?
Okay, thank you. Get it.
Yeah. Oh, thank you. Thank you. I've never inserted an Excel file into an answer. Not really. Yeah. Okay. If you can think of other things, by all means, write to me tomorrow or the day after. Yeah, you must stay at your desk undisturbed during the entire time. That's about it, I think. At the end of the exam, it will just disappear by itself. I think you know that. From the moment you click on the exam, there will be 2 hours and a quarter. So Sam, can we use Excel and calculate throughout the whole exam? Yeah, I think yeah, you can. You are allowed to. Yes. Thank you, Shufan. Please remain connected, either via chat or via Zoom, because what we'll do 5 to 10 minutes after the end, I will check to make sure everybody has submitted something. But whether you have submitted your complete set of answers, please understand, in a big class, this is your responsibility. It is your responsibility to make sure you have stable internet and submit all the work, and where applicable, submit all elements of your work for that one, what I call exceptional question which requires you to use Excel and Word or PDF. That question, you have to get it to us in a timely manner. Okay, it'll all be quite clear to you on the day. Okay. All right. Now I want to just very quickly, just on the exam itself. I think you'll be all right, because you know I've worked with Xin Ming for a number of years, and his material is always, you know, very clear and self-explanatory to a great extent. So if you have been paying attention in lectures, if you have been doing the assignments, and then following the classes, and if you study his notes, honestly, you don't have any problems. We're not here to trick you or do some really nasty stuff and give you a hard time. We're not in the business of doing that. Okay, so I think you will be fine if you do all those things. And if you have any further questions in the coming few days, do let us know. What I want to do tonight, though, is I'm going to talk about a couple of very interesting trade stories. And in telling you these trade stories, I think, you know, when you understand them, oh, this is quite entertaining, but there's a lot behind it that will be helpful for you to master, you know, the key concepts of this course so far. Okay, now I'll come back to this in a moment. This relates to negative oil prices, but first I want to go back to 4T. Now in 4, that's just the last tutorial. Okay, so we talked about the trading game, and I want to just quickly remind you of the inputs that are required to price an option. Okay, now the key ones, you know, this as you probably know, this is probably the most frequently asked question for entry-level jobs for young graduates trying to enter the finance industry. What are the inputs required for pricing an option? It is these are the ones in front of you. Okay, so the spot price, the strike. If you don't count the strike, then the price now, and then how long it is, the risk-free rate, dividend yield, and volatility. Okay, and then it's worth mentioning that in the case of equity options, and we will come back to this shortly, when you're talking about pricing equity derivatives, not just options, equity futures as well. So if this is the pricing date, let's say this is the expiry. And if there is a dividend payment here, payment date. Now, quite often when you are here, you don't know how much will be paid. Okay, now just to give you an idea, so I'm going to go to There's a website called optionprice.com. And or is it option pricer? Optionpricer.com. Option prices. What? Available for sale? No, that's not the one. Option price. Maybe option price with a dash and okay, this one. Option-price.com. Now, so not to worry about the rounding and graph increment and all that stuff at the bottom. You see there are 6 inputs: volatility, dividend yield, interest rates, days until expiration. This is calendar days, I think. So 30 days is actually 1 month. Exercise price. So this one is actually priced what we call ATMS, at the money spot. So price is simple. It's just what you see in the market. Exercise price, you know what that is. No argument about days until expiration. No argument about interest rate. Dividend yield. What on earth do I put in here? Now, this is the million-dollar question, and we will be coming back to this. But what I want to say to you now is, oh, I lost all those scribbles. When you are pricing, this is the pricing date. This is the pricing date. And this is expiry. And if you know on this date that a dividend will be paid or may be paid on this date, but you don't know what it is yet, this is the dividend payment date. So that is normally, there's a schedule. And, you know, quite often, just some time before that, there is an announcement. So dividend announcement. ANNOUNCEMENT. So here, at least at this point, you will know what, but when you are here, well, you don't know. Now, if you don't know, how are you going to deal with that? Well, you make a guess. You make an assumption. And that is what goes in here. That is what goes in this dividend yield thing. So I think a lot of students, they see this field, oh, okay, dividend yield, okay, 2%, but they don't always know the implications behind it, okay? Which is sometimes you don't know, and if you don't know, then the market collectively is making a guess on that parameter. All right. So that's something to emphasize here. Okay, now we will actually come back to that topic a little later on. I'm going to talk to you about trading futures role, and this is related to a very interesting incident that happened in January 2008, and it is derivative trading at its best, I think. Okay, now, so here is a payoff diagram. This does not include the premium you paid. It's just, you know, I think this is a call option strike 50 from what I can see. So if you buy a call option strike 50, and if the share price ends up at 60, then of course you're going to make $10. Okay, but please note that the straight line the straight line is what I call the terminal payoff. So this only happens at the end. So you can imagine if you have an option which has just got 1 day or 1 hour to expiry, then yes, it would look like the straight line, okay? But if you have a call option, strike 50, you buy that today and it's got 1 month to run. And 2 days later, the stock price jumps to 70. Well, it may not look like this because the line is going to sort of levitate. It will actually start to drift away. Now, the best way for me to impress that upon you is by showing you a pretty cool software gadget called the Wolfram CDF. And I'm going to do that from the other screen. Hold on a second. Yes. Okay. Now, so here, I think this is a payoff of a call option with strike equals to 100. And what you can do here, okay, the strike price, okay, this is the first one is a strike price at 100. These are all the values here. Okay, I hope you can see it. And so my point to you is you can actually change these. So you can see if the time to maturity is 0. Now, this is where you get the straight line. You got me? But as bankers like to say, all things being equal, everything equal, okay, it gets longer and longer. So for a 1-year option, if you have a 1-year option and the strike price was 100, then, you know, depending on where the stock price is right now, your valuation curve would look like this. Okay, so you're thinking, okay, how do I make sense of this? Well, this is time decay in action. This is the option decaying back, coming back to Earth. Okay, and of course now I can, okay, I'm just going to put this at 0.5. Okay, that's close enough. 0.498 years. So now I move volatility, and you can see and you know that very well by now, and you're not just having classes with us, you're also doing this in derivative markets. Okay, so when volatility goes up, option price goes up, and when volatility comes down, option price goes down. I love playing with this. This is so much fun. Dividend yields. Okay. How about someone tell me, when dividend yield goes up, what happens to call option prices?
Decrease.
Decrease. Zhongyuan, very good. Why is that?
Actually, I can memorize the Black-Scholes formula.
Wow. You can memorize the Black-Scholes. Okay.
But the problem is when I really try to apply it, I try to memorize this using binomial tree. So the problem is, if you apply binomial tree when reaching the next period, the stop price, the current stop price will be lower because you have to consider the dividend discount. Yeah.
And there you have the key to the answer. It is because when the dividend goes up, okay, I'm going to come over here and for quickly. When because the forward is equal to the spot plus the interest cost minus the dividend, right? I'm not using compounding and this and that, just very simple English alphabets. So when this goes up, this must come down. And when the forward price comes down, then your call price also will decrease because it's all driven by the forward price. This is the way I try to see. I used to be able to remember or memorize or Black-Scholes. But now I try not to. But if you are able to, good for you. So when you I'm going to move this dividend. I think you kind of can see, right? But not really so noticeable. But the curve is sinking a little bit. And then for interest rate, when interest rates goes up, option price, or at least the call price goes up. Okay. Now I'm not going to disturb the strike. Okay. Now some of these properties are shared by put options. Not all of them. Okay, but a lot, not all of them, but many of them are. Like time to maturity and volatility. Dividend yield, well, it goes the other, it works the other way. And same for interest rates. Okay, so I just want to draw that to your attention that whenever you see these straight lines, well, they're only applicable mostly at the terminal point, okay, at maturity. Otherwise, an option valuation payoff graph should look like this. All right. Now that we have got that out the way, I want to show you some statistics. Now, this is I got this from Bloomberg not that long ago. If you have very good eyesight, you can see down at the bottom here, 1st of April 2022. Now, what is this? This is what we call the volatility surface, and this is the volatility for Apple, the stock. In fact, if you bear with me just for a few seconds, I want to see if I can show you a better version of this. Okay, just give me a moment. I appreciate you joining me, and I'm going to make this as entertaining as I possibly can. Okay. I'm going to try and log on to Bloomberg. I will be able to show you shortly. Bear with me 1 second. I mean, we can always come back to this later on, of course, even if we don't do it today. Okay. Now, Let me switch over to the other screen. I'm going to share screen. So the implied volatility at this time, when I captured this screen around 3 weeks ago, the implied vol was somewhere around 25, as you can see. I don't know if you can see that, between 25 to 30. The first thing you notice is that it's not uniform. Now, what are these sets of prices? So first of all, you got calls on one side, you got puts on the other side, number one. This is regarding the options for Apple, the stock. And when you go down, you have different maturities. So I capture this data on April 1st, 2022. So these are options for 2 weeks. So maturing April 14, and then May 20, and then June 17. Actually, for Apple, for a stock that is so actively traded, I think there are options maturing every single week. That is why I really like that market, because there's so much to play around with. Now I'm going to just go over here and show you this. So this is the equity. So all you do is you go AAPL US, and Bloomberg is kind of intelligent enough to know what you are thinking. So you just click on equity, and you can get a description that just tells you, this has all the company information. You can go OMON. That, I think, is the screen that I just showed you just now. Option monitor. So here is a more up-to-date picture of the volatility of app. Now you can see now the values are up. So IVM, implied volatility measure, I think. A lot of things you can say about this. First of all, when you go down, so this is for options maturing 20th of May. But there are options every week. They're only showing them monthly. I'm curious. And then you look at the one maturing middle of June. The volatilities are different. When you go down, the volatilities are different. Number one. Number two, the price it closed at 165. So this one is ATMS, or at the money spot. And you can see either side. So a 160 call or 170 call, the vols are different too. They're all different. And you can see also volatility goes up. And then it goes. Now this is what traders call, the volatility smile or the vol skews. They're all different, and when you come down here, it's different. When you look between calls and puts, sometimes they can be different as well. Okay, and that's called the what's that called? Risk reversal. Okay, the put call volatility gap. And then you can go OV, which stands for option valuation. And here is you price a very simple, very basic, completely plain vanilla American call option on Apple, and it defaults to, this must be the market implied vol at the time. Now, if you want to price exotics, you just come up here, you click on vanilla. You see there's a whole load of stuff. You can go into Bloomberg you can spend all night, you can spend the whole of Easter in there and get completely lost in the fun of playing around. Have you heard of these options? Do you even know what they are? There are so many. I can't tell you all of them. But you know, one day, you know, try to play around with this. But what I want to show you actually was this. If we go to volatility, look at this. How cool is that? Now, apart from being cool, I'll tell you what this is. So just now I was telling you that you have to imagine in a sort of three-dimensional space, okay? The three dimensions being the price or the strike, sorry, the strike is first dimension. Second dimension will be the tenor of the option. So as you come down here, the third dimension is where the spot price is. And then what's term structure? Term structure. Oh, okay. It's just showing you, I think, the implied vols of various calls of various tenors with regard to, so this is putting it in a table format. But you know what? If you go to OV, which I did just now, and then you go to volatility, it is now showing all those numbers that I was showing you, but in a three-dimensional summary. So there's moneyness. So if it's 100%, that is just at the money, but I think it's at the money forward, not at the money spot. So different degrees of moneyness. And then the term here is just how long the option is. All right. And then the volatility is the third down. I mean, the volatility is what you want to know. So you can see that there is a pattern to it, and you can study this. So it's not an accident that it looks like this. It's just sloping down, and sloping that way. So the options which are nearer to maturity, actually they have a higher vol, okay, especially the out of the money options. I mean, this is a classic implied volatility skews that you hear. And then here, this graph here is just a projection, if you like, of whatever I might be looking at, okay? I don't know, I love playing with this. I hope you are impressed, okay? So I wanted to just give you an idea of how options behave. Now that was the whole point. Now I want to tell you a story. So we already talked about this. Okay, now I want to tell you a story which is to do with trading future spreads. I mean, you can trade calendar spreads and options, but I'm talking about futures in this case. Now, first of all, what is a calendar spread? Well, that is easy. Sometimes it's called futures roll. It's got nothing to do with bread, okay, or daily France, not that kind of bread roll. Futures roll. And I'm going to use very simple notation. I know that you are encouraged to use continuous compounding in your midterm, and please do so, okay? But here, I'm going to make it really simple. So the forward price is equal to the spot price plus the interest cost or the interest rate minus the dividend. It is the same thing if you write f is equal to, you know, e to the power of what is it, r minus q time. It's the same thing, okay? It's just this is more fancy, but this is very primitive. Fine with me, as long as you understand it, okay? Now, is everyone okay with that? So the futures price, I'm not going to derive that. I mean, you know that by now. You've been told 17 times how this comes about. When you trade a strategy called futures calendar spread or futures roll, it can be long or you can be short. Now, if you go around telling people, oh, I'm long the futures roll, it means you are long the long contract and short the short contract. What the hell does that mean? Let's say there are two futures contracts. There is one that matures in 1 month. I call that F1 month. There is another one that matures in 2 months. I call it F2 months. If you are long the futures roll, you are long the long one, and you are short the short one. If you are short futures roll, is the exact opposite. So when you are long, you are long the long one, short the short one. But when you are short the futures roll, you are short the long one and long the short one. Okay. And never mind about this. We talk about the long side first. Okay. Let's just say we're making very simple examples. The interest rates are not 12%, nowhere near, and I hope they don't get anywhere near 12%. Okay, let's just say they are, and spot price is 100 right now, and now here you remember what I said to you earlier. We don't know the dividend, but we just think it will be $1.50. We think it is, okay? Or not we, the market thinks it will be. Then, so what? So you can trade on this. Now, so for the 1 month contract, the price of the 1 month contract should be equal to the spot price plus the 1 month interest cost minus the 1 month dividend. Now, because there is no dividend in the first month, so if this is the time now, this is 1 month or 30 days if you want. This is 30 days. And then this is 60 days. Now, I told you that we expect, and the key word, the emphasis is on the word expect. We expect there will be a dividend of $1.50 here. So the market, in other words, is pricing in a dividend of $1.50. Now, please understand the market is not always right. So if you argue with the market, if the market is wrong, well, I guess you are a good trader, okay? But we do know that because there's no dividend in the next month, so D1M will be 0. But there is a D2M, there is, and we think it will be 150. Okay. Now, if you long the futures roll, you long the long, short the short. So you long F2M and you short F1M, the price of that would be long this one and short this one, which means it will be this minus this. Now this is zero, as I said, there's no dividend in the first month. So these two cancel out, and what you are left with is a very short-term curve play, because this is the interest rate of 2 months, but this is negligible. And if you have a flat curve, if you assume, just for simplicity, if you have a flat curve, then, well, okay, look, if interest rate was 12% per annum, then the 2 months interest cost is $2, but the 1 month interest cost is $1. Okay, just dividing 12% by 12 for every month. So what this means is, and I'm making it really simple for everyone to follow. So $2 minus $1 minus $1.50. What's that? Minus 50 cents. So that means if today you go out there and you long this futures roll, you actually will get paid. You're not paying for it. Okay, somebody will pay you. Is everyone okay? Now, that is how much this thing will cost you right now, but that is not really so interesting. The interesting part is, why are you doing this? Why do you want to do this? Okay, so, and the reason is very simple. The reason you do this is you don't care where the interest rate, this is a long road. You don't really care where the market is going to go, but you are taking a view on this, because if this goes down, because there's a negative sign, your long roll will make money. That is why you do this, because you want to take, in essence, a market neutral view on the forthcoming dividend. You don't think it will be 150. Let's just say when they make an announcement, and maybe they will make an announcement somewhere between now and the next 60 days. I don't know when. Okay, but let's say they make an announcement here. Let's just say they do. And the announcement was that, oh, we can't pay 150. We can only pay 50 cents. Let's just say. Okay. Now, when you went in with the long roll, the price was $2 minus $1 minus 150. But that's when everyone was expecting the dividend will be 150. What if after they announced, it was very disappointing? Now the roll is going to reprice itself. I'm just going to keep the interest cost constant, because that is not so relevant here, okay? But it's going to reprice. So when you bought that, it was negative, so you will pay this amount, okay? But what is the price now? So 2 minus 1, this is 50 cents. Okay, now this is positive 50 cents, but this is if you want to go long now. If you want to go long now, you pay 50, but you are already long. So you can sell this and someone is going to pay you 50 cents. So end up as a round trip, you've actually made $1, okay? By having a view on the dividend. Now you have to understand this part so far to understand the story I'm about to tell you, okay? The story is regarding, okay, just in summary. So when you are long the futures roll, it means you are long the interest rate differential and you are short the dividend. So if you short something and it goes down, then you make money. And this is just a summary of what I've been saying to you for the last 10 minutes. Now, I'm going to finish off telling you a very interesting story about Soc Gen, the French bank. Okay. Now, in the so everyone knows Soc Gen blew up in January 2008, but not many people know this true story. I've actually met some of the traders who were involved in this incident, and I will explain to you what happened. Okay, so in the early part of 2008, I think it was around January 22nd, somewhere around there. So this was, so 2008 in the autumn was when we had the global financial crisis, but just shortly after the new year, already things were not really looking that good. I mean, Bear Stearns collapsed at the beginning of 2008. And then there was a trader, Jerome Cavill, who is, I don't know if he's still in jail, but he ended up going to jail. He was hiding some losses in his equity derivative, and SocGen had to actually make full disclosure, and then they had to close a lot of losing positions. And I think they lost close to 5 billion euros in less than a week. Once they discovered his trading losses, so they had to very quickly unwind all the positions and make sure everything is properly settled. SocGen ended up losing $5 billion, and they made that announcement somewhere around this time. Okay, so this is the background. Another crazy trader causing a lot of losses to their bank. There was substantial market turbulence, and there were serious losses. And of course, the stock price of SocGen went down the toilet. But there was a mispricing, and this really happened. Okay, there was a mispricing in the futures contract, in the CAC 40 futures contract, which was the futures contract, the equity futures contract for the French index. There was a mispricing in there that was not picked up by most professionals. It was picked up by some, as I said, and this was the person, one of them told me this story. Now, what was this mispricing? This mispricing had to do with the long futures roll. Okay, so just going back earlier, it just so happened that at that time, so you're talking January 22, somewhere around there, okay? And let's just say there is a futures contract maturing in 1 month, and there's a futures contract maturing in 2 months. Now, so CAC 40 has 40 stocks in there, right? And as it happened, the only company that was scheduled to pay a dividend between February and March was SocGen, the bank. So let's say this was the dividend payment date and has not been made yet. Okay, so imagine you are here. Imagine you are here. Okay, actually, maybe it's better if I now after I tell you this interesting story, I'll let you go, unless you have any questions. Okay, I'm going to draw the timeline again. So January 22nd, there is another futures contract, Feb 22nd, another futures contract, March 22nd, and somewhere in the middle, there is a dividend payment date, dividend payment for SocGen, and nobody else, no other company is scheduled to pay a dividend between February and March. And we are now in January, and we don't know what the dividend payment might be, okay? Imagine this. So before this SocGen thing blew up, before the market even knew, let's just say at this point, S0, so if S0 is equal to 100, and if the interest rate was 12%, now I know these are high numbers, but it doesn't matter. And let's just say the market is expecting SocGen to pay a dividend, so dividend SG of €1.50. Now I'm making it up, but I'm using very similar numbers. So if you are long the futures row, then as I said, it's equal to the interest cost of 2 months minus the interest cost of 1 month minus the dividend. And this is equal to $2 minus $1 minus 150. Oh, I should be using euros. Okay, so 2 minus 1 minus 150 is minus 50 cents. So if you went long at around here, then you will be paid this amount of money. Now, here's the funny thing. So when you are long the futures row, you don't really care about S, the spot price, because the spot price is not even in your formula. It doesn't matter whether S goes through the sky or it crashes to the basement. What you are trading principally is this. Okay. After SocGen made the announcement, I'm sorry, we blew up. So markets were very volatile, but the futures were still trading in a similar manner. And the assumption on the dividend did not change. So although markets were volatile and the SocGen share price, so this probably crashed all the way to 85 or something. But if you're long the futures row, it doesn't affect you. So for about a week, you can still long this futures row and you still get paid 50 cents for about a week from here to here, after they already announced their huge losses. And then some trader, they said, well, hold on a second. So SocGen just made an announcement that they had a huge loss, which nearly brought down the bank. So there is no way they can actually pay a dividend. So this number should be 0. In other words, when you are long the futures row, the price really should be just this, which is $2, minus this, which is $1. Forget the dividend. Dividend will be 0. Then there's no way they can pay a dividend. Absolutely no. So the futures row should be $1. You should need to pay $1 in order to be long this futures row. But the market never realized that. The market was still pricing in the dividend as before, until some trader they just kept going long and long and long and long. They were long until they got a whole boatload of long futures rows. And then someone realized, okay, what are you guys doing? And then people started to realize, hold on a second, this one is not priced correctly. This one should be 0, which means if you're long the futures row, we should not be paying these guys. They should be, you will be making exactly, not dollar, I apologize, €1. So they have made €1.50 of arbitrage profit because of that mispricing, which went on for over a week. All right. And this was the long the row on the calendar spread of the CAC 40s futures. This happened in, as I said, the early part of 2008. And it's a very classic case of, mispricing in the derivative market. I think the reason the derivative market is so interesting is that if you buy stocks, okay, stocks go up, you make money, stocks go down, you're not happy, go up, go down, go long, go short. It's very simple. You never have this kind of interesting challenges to work with. And you never have, now this is because of the timing difference between different contracts and something happening between month 1 and month 2. In the commodity world, you have contango and sometimes inverted curve backwardation for different reasons of seasonality. Again, that is another very fascinating aspect of derivative trading. We touched on that earlier. I have another story I can tell you, but that'll have to wait until next time. It's why around 2 years ago this time, the futures price of oil actually went negative. I think you know about that story. This happened 2 years ago. Now we can talk about that next time when we get a chance. But this week, there's actually I picked this up 2 days ago. There was a news story in the Guardian and the Financial Times about a group of traders in the UK who are now being extradited. 引渡 okay? Hindu, not Hindu. This is Hindu. Right? How do you say this? How to say 引渡?
引渡.
Hindu. Thank you, Shupan. Hindu. They're being induced to New York to face a trial for potential market cornering and collaboration. Now, I'll tell you more about this next time. But this story was 2 days ago, but it's related to an incident that happened to oil price 2 years ago. Okay. I have also yeah, this one here. Okay. But I prepare some news, not news. I prepare some notes on just on the topic of hedging. But today we don't have time. I'd like to share that with you before you go. I mean, before you leave this program. I think for those of you who have an interest to go into derivative marketing, it is worth knowing. But that'll have to wait. Okay, I will share this with you on another occasion. By the time we get to talk about this, you would have completed your midterm. Okay. I think we can call it a day here. Does anyone have any questions they would like to ask?
Yes, Sam. Actually,
Okay.
I still don't understand the price of the long futures show. Because the 2 months interest minus the 1 month interest minus the dividend is cannot interpret it as the total cost I need to pay.
Correct.
But it seems
Yes, it is.
yeah, because it seems like ignore the time value of interest, because the amount I need to pay is in I mean, this is one is the amount I pay and minus the amount that I receive, but they happen in different time. So which makes
Oh,
me
no. No, let's say this is today. This is today.
okay.
Or if we use that SocGen timeline, this is January 22. So today, if you put on that long futures roll strategy today, then today you are buying the futures contract that matures. Oh no, you long this one. Okay, you are buying the March one and you are selling the February one. So you go long this one and you short this one. So all I'm doing here, if you want to do it longhand, using a very, very basic formula. So the futures for 2 months, today, looking at it today, both of them, the 2 month futures will be the spot price plus the 2 month interest rate, or interest cost, I should say, which is $2, minus whatever dividend will be paid. This is simply just pricing the futures, and then today, the 1 month futures at the same time is the spot price plus the 1 month interest cost minus the 1 month dividend. But I said there's no dividend in 1 month. So you can see if you long this, then you have to pay this. If you short this, somebody will pay you. But anyway, if you do this as a combo, you just add it up. Well, no, actually, This one might, because there's a minus sign. So S minus S is 0. 2 minus 1 is $1. But here there is a minus 150. That is where that minus 0.5 came from. Are you with me? Is that okay?
Yes. Does that mean can I understand it like this? The long future role can be treated like a product, not the investor treats the two futures separately. It's just a combined product. So in the first day, if I long this row, then I can receive $0.5.
Correct. Correct. Absolutely. You're spot on. Yes, you're right. What you just said.
Thank you.
You're welcome. You're welcome. Let me see if I can show you. So, yeah, so you can okay, just to give you an example. Oh yeah, I should mention you can sign your attendance now in Blackboard. I'll give you until 10 p.m. to sign it. Okay, but I'm just going to share with you here. This is and this, you know, what I've just been telling you, it only applies, I guess, to equity futures contracts because they pay a dividend which is unknown, which then allows for speculation. But this is the June contract, 4,388. The September contract, 4,387. So you can see it's practically flat, which means that the interest costs or the interest differential minus any dividends you may have, the sum total is practically 0. So it's very flat there. It doesn't mean you can't take a view. All this means, Shufan, in answering your question, if you long this one, you pay 4,387. But if you short this one, you get paid 4,388. So on a net basis, you actually get paid 1 point. Because it's 4,387 minus 4,388. All right.
Hello, Sam. I
Okay.
have a question. Okay. Hello, Sam. I have a question there.
Sure.
If we assume this derivative as a if we assume this derivative combination as a derivative product, then will its value be equal to minus 0.5? Can I understand in this way? Its value is negative. So we should short this product when it's when it's negative 0.5.
No, I wouldn't look at it like that. Whether you long or short something does not depend on whether the sign is positive or negative. Now, if you want to, hold on a sec. If you buy something, if you buy something at this level, if you go long at this price, there's only one reason, because you expect that after you go long, the price will go up. Now, when you say the price goes up, it could mean it's $10 and then it goes to 12. That's going up. It could mean it's 100 and it goes to 120. That's going up. It could mean, and listen to this, it's minus 150 and it's now going up to positive 50 cents. That's still going up. It's just, it's crossing the boundary. I don't care. I care about the direction only. I don't care what is the sign that it starts with. Are you with me?
Oh, okay, I get
Yeah.
it. Oh, I can understand in this way. If its initial value is minus 0.5, if its current price is 0, then I should go short to short it to minus 0.5. However, if the current price is lower than minus 0.5, I should long it to minus which I should long this portfolio to minus 0.5.
You only care about the direction.
Oh, okay.
You don't care,
okay.
which is why, by the way, and you asked me this question the other day for capital markets. Why is it that people are trading bonds with negative interest rates? They don't care it's negative. They think it can become more negative. That's why. So it's the same logic here. I don't care what sign I start with. I only care about the direction. Okay.
Okay.
I think I better let you guys go.
I have another question. It's
go
about
ahead, go ahead.
interest. If in 2008 there is a stock crash and the S should decline dramatically, then I suppose the interest rate should also get lower because the interest rate is calculated based on the S0. The S0 has changed.
You are right. You are absolutely right. And I agree with that. I agree with what you said. But interest rates do not go suddenly from 2% all the way down to 0. Interest rates don't move like that. It would have some effect, but it is a lot smaller than expecting there was a dividend and suddenly that dividend should just disappear and no one else noticed. That is far more, that has a far bigger impact. But I actually, what you just said is correct. It's true. It's just, it plays a smaller role because you are, well, look, you're talking $100. And I mean, interest rate was not 12%. I just use that as an example. In 2008, interest rates were very, very low. So you might be talking like, 3% interest rate, dropping to 2.5 or something. And then, so it's just a 50 basis point drop. And that is over 12 months, don't forget. So you are talking 4, which is nothing. Well, I mean, okay, it's something, but not really that important compared to the dividend mispricing. Are you with me?
Oh, okay. But I wonder if S0 drops from 100 to 95, then will it influence the interest, not the interest rate?
Yeah, it will actually. It does. It does. But that's a completely different discussion. It will impact you. And in fact, when you need to post margins, it also has an effect on that. But I think we better not get into that because you can get confused.
Oh, okay.
Okay. please, everyone, please sign your attendance until 10 p.m. Just to conclude, two things. Number one, if you have any questions in the coming days, you can still reach out to us. Number two, please form your teams. Okay, apart from fish burger and chicken fillet or whatever and Big Mac, anyone else who doesn't have a team, please form your teams. Otherwise, I will do it for you after Wednesday next week. Okay. Bye for now. I've kept you long enough. Thank you for listening. And I wish you a very good evening. Bye, guys. Take care.